all about COVID-19 tax tips, what you can write off, what you can't write off, what's a loss, what's not a loss, today on the podcast.
This is the Wedding Industry Law Podcast, a podcast dedicated to wedding professionals that are just trying to keep it legal. And now, your host, Rob Shank.
Hello out there, welcome back to the podcast. Today we're going to be talking about taxes. What are some strategies that you can implement due to COVID-19? Can you write off losses from weddings that have been canceled? Can you write off home offices now that you've moved out of your retail office space and into your home? What are some of these tips that we can use that are hidden inside of our tax system to make life easier for us in this COVID-19 day and age? But we're not doing that alone. We're going to have a special guest, tax attorney Jason Wiggam, out of Atlanta, Georgia here. It's going to be a great episode. But before we get into it, I have one ask. Please mosey on over to our Wedding Industry Law YouTube channel. Hit the subscribe button. You don't have to hit anything else. You don't have to watch anything. Just subscribe. I will be your best friend. I would really appreciate that. If you're enjoying the content of these episodes, please hit me up on Instagram. Please shoot me an email. Please leave a comment on the YouTube channel about what you want to see if you've got a suggestion. And with that, we'll get into the episode. As I mentioned, all about taxes. We're going to have Jason Wiggum on the show. He's an excellent tax attorney. I know by experience. He's helped me avoid a lot of money in taxes over the past couple years, and I'm super happy to have him on the show. Jason, welcome to the show.
Hey, Rob. Thanks for having me.
Awesome. Now, your firm is not unfamiliar with this program because I had Will Gear on here probably now going on a couple months ago, talking about bankruptcy. So I wanted to get the whole firm represented on this podcast. So Jason, really appreciate you coming out. I know we talked about bankruptcy with your partner before, but what else does your firm do, and why is that important for the sake of this episode?
Sure. Yeah. So Jason Wiggum, I am one of the owners and founding partners of Wiggum and Gear. We're a law firm in Atlanta, Georgia, downtown. And we specialize in tax resolution. So we're tax attorneys and bankruptcy. I'm the tax attorney side of the firm and my team. Sort of quickly, my background, I went to Georgia State and then NYU to get a master's in law and taxation. And I exclusively represent individuals, businesses that have problems with the IRS or state agencies, income tax, payroll tax, sales tax, any sort of tax problem, liens, levies, all those tax problems and nasty things the government does to you when you have an alleged tax liability. We represent clients nationwide because it's a federal practice, and I'm happy to be here.
Excellent, thank you. So that the listener understands correctly, Jason is the type of attorney that knows the tax loopholes, as they say, and can get you out of tax liabilities, maybe based on those loopholes, and that's countrywide. So he knows all about taxes, all about tax loopholes, and that's why we got him on. So the first question I have, because again, as you know, as you came on here, this is the listenership of this podcast is mostly wedding professionals. And as you know, COVID-19 is essentially handicapping and kneecapping, I guess would be a better term, the industry. So many of my clients, many wedding professionals out there have had weddings that they've taken money for, okay, but because the data's perspective, it hasn't been done yet and it got canceled. And so now they're in a no man's land of they're having to return them a certain amount of money. Maybe they're having to forego something or reschedule, but essentially losing value from a contract that they would have already or would have seen. Are there any type of, when I say tax loopholes, are there any type of tax breaks, tax loopholes, any strategies that you recommend for a professional that is having to give money back to a client or is not going to see the remainder of a value on a contract because a wedding was canceled?
Yeah, sure. And there's a lot to unpack there, so I'll do my best. I would.
I'm not
Yeah,
the best host, so like
no, you're good.
we can
It's all
walk it in
good.
little steps as you want.
No, you're good. And I think I'll just start going and then interrupt me if you have questions. I will say this is definitely sort of generic advice. You should talk to your CPA, whoever prepares your tax return, because there are differences with different business entity types and things like that aren't going to be applicable for everyone. But in general, and before I would go in, I was actually supposed to be at a wedding this past week, and that had been canceled. And I get it. We had booked our travel and all this stuff, and it was a nightmare. So I can't say I know exactly what the
In
listenership
some
is.
small way, you
Yeah, it
understand
was
what's
a little part of it, and it was unfortunate for everyone. But so look, the lost value of the contract, probably not going to be able to write that off. Most smaller businesses are what are called tax basis. Their accounting method is called cash basis, not tax basis, cash basis. And what that means is when you only take in income if you actually receive cash, and if you have losses, it's what you actually pay. There's another type of accounting called accrual accounting, where you can earn income before you actually receive the cash. And with accrual, you can take write-offs for like lost work and contracts that don't work out. Here, any actual expenses they incur, they can deduct. And if they were experiencing losses, the CARES Act, the stimulus act that was passed earlier this year, there were some provisions included that allow for sort of enhanced loss carrybacks. So I don't want to put anyone to sleep, but basically net operating losses are losses that a business earns, and you can carry them back and carry them forward to different tax years if because you're not using it in the current year, you have the loss. If so,
let
yeah.
me interject there, because
Sure.
I think you brought up an extremely good point, and I want to make sure that we hammer this home, because we're talking about losses. So the definition of a loss, if I understand you correctly, depends on whether or not you're using a cash basis for revenue or a accrual basis.
Yeah, and most small businesses are going to be cash basis.
Okay, so by way of example, then, and that's important. So by way of example, let's just say that I'm a wedding photographer, and I signed a client up, let's say January 1, and the contract value is $10,000. The wedding is on November 1. So I take $5,000 as my initial non-refundable payment. Okay. And with the idea that I would take the other $5,000, it doesn't matter. November 1, the day of the wedding. Okay, fine. Client cancels the wedding June 1. So the loss isn't, if I understand you correctly, the loss isn't the $5,000 that you're not going to get. It's whatever you weren't out of pocket for in the original $5,000 that you took in.
Sort of. It would just be whatever the business earns, right? So I guess let's say they have to return the $5,000 deposit. That would be an expense. Like they would have, I guess, recognized it as income, and then when they return it, it's an expense. And then, I'm assuming they have normal business expenses they're incurring, and they have no revenue. So, zero revenue and expenses, zero revenue minus a positive number is going to be a loss. I just meant there's no specific deduction for that lost business. You don't get anything if you didn't earn something in the first place, basically.
I see. So I guess it's not earned, like the $5,000 that you're not going to get because even though you contracted for it and you were theoretically supposed to get it, even though you're not going to get that 5,000, it's not necessarily a loss.
Correct. Yeah. Okay. There are certain situations where, with like loans where you can have an obligation and that's not repaid and it can be a loss, but here I don't think so. If you're an accrual basis taxpayer, like that's the accounting method, when you sign the contract, you probably recognize all of the income. And so then once the event happens, there's probably a write-off associated with it, so with that being said, I am not an accountant, so if someone hears this, they should still, check with their tax advisor, like I said earlier. But I think in general, there isn't a loss in that situation. It's really, if business is going poorly, you might have a loss just because of that. And, there are some benefits related to that.
Okay. So, all right, that's fair enough. I don't want to dance on, on something where I have you on for taxes and we might be getting into that accounting territory. I get that. So, I cut you off while we were talking about, I think the CARE Act and how that intercedes with what we're with.
Sure. So let's pretend, someone has a loss in 2020, right? Like they prepare their tax return next year. There's a loss. You can carry that loss back to prior years. And what that means is the prior year return gets amended. And if you paid taxes for those years, those funds get refunded back to you now. So it creates cash for you. It's a change because under the prior rules, so pre-tax reform, you could carry back losses and do some things with it. Then tax reform limited your ability to do that. You can still do it, but not like you could before. Now we're back to the original rules and they made them better. And you can actually, if you had a loss in 2018 or 2019, I hope they didn't, but if they did, you can actually carry those losses back farther, 5 years instead of the normal 3. So there were a lot of people when the CARES Act were passed, a lot of businesses that were amending tax returns and doing things to generate cash for themselves. And that was one of the methods.
Okay. So then can you maybe kind of unpack a little bit of what are some particular COVID, and I'm saying deductions and loopholes because I'm a moron. So, and I'm a
You're not a moron. I got you. Like, is there anything else that's out there?
Yeah. What else can a listener be like, oh, let me go take advantage of this particular COVID related item within the tax code?
Yeah, there are a few. So one of the bigger changes was, if you have a retirement account, depending on the type, you generally can't take money out of it until you're at least 59 and a half without having a 10% penalty on top of the income from the money you took out. So they added the Internal Revenue Service, Congress added a provision to the CARES Act where you could have the penalty waived if the distribution is related to COVID-19. And basically, either you or your spouse would have had to have been diagnosed, or you experienced adverse financial consequences due to quarantine or your working hours being reduced or whatever. So most people, or everybody, yeah. And then on top of that, and this was kind of unique because there are situations where you can get out of that 10% penalty before this. They have this new thing where, so they waive the penalty, and then you're going to pay income tax on the money you take out because it's income to you, retirement income. They let you spread it out over 3 years. So if you took out $100,000, the first year, $33,333 would be recognized, and then so forth and so forth. Normally, when you take money out of a retirement account, you have 60 days to put it back in. It's called a rollover to prevent those funds from being taxable. They are allowing you 3 years to put the money back. So it's like a free loan. Yeah. So, I think in general, I'm not a financial planner, but, I think they would say like, hey, not a good thing to take money out of your retirement account before you're retired. And, so it, obviously not something you would want to do unless you had no choice, but it's you can access funds that way and the tax hit is greatly diminished. And then you could even use it as a loan to repay.
Right.
potentially if, things improve next year or, whenever. There were some other provisions. So there's payroll tax deferral. So if you have employees, you could defer the payroll taxes that the employer pays for the employee. So it's about like 6.5–7% of the employee's wages that's paid as payroll tax. 50% deferred until the end of 2021, 50% deferred into the end of 2022. It's something you'd want to communicate with your payroll company on, or whoever helps you with payroll, because there's some forms you have to file and some things you have to do. Originally, you couldn't do it if you took PPP funds. They changed that later. These things constantly change, but you can have a PPP loan and defer payroll taxes. So this is going to apply for anyone who has an employee, and it's just a free loan from the government. They're not going to charge interest, but I do worry there will be people who do this and then don't plan for the amount being owed at the end of 2021. And I represent people who don't pay their payroll taxes, so I do worry that I'm going to get a surge in clients then. But just know what you're doing going in, and you're reducing your expenses, preserving cash, and it's short-term financial relief. A low-cost loan with a very short term.
Right.
There's another credit that you could take if you did not do the payroll protection loan, the PPP loan, called the employee retention credit. So if you have employees, it reduces your payroll taxes by a pretty substantial amount. So it's only if you didn't take the PPP loan. Also something you would do through your payroll company, basically up to like half the employee's pay to, I think, a $10,000 per employee cap. I forget the specific number, but it's a substantial amount of money that the government credits you for free. A tax credit is basically like they're giving you free money. And it's not income to the person. So if you didn't do the PPP, this is something great to do.
Right.
Beyond that, there's some other stuff, but it's really for larger companies and things. Those are the biggest items for.
And that's fair enough. You were starting to sound like the guy that wears the green, maybe not, it's not green, but the jacket with all the cash symbols on it.
Money for you.
Yeah.
For you.
I was actually, that's what's interesting is like, I don't know if I was listening to NPR or some extended interview with that guy. And like, it's a super interesting dude. Like he is just like all the information that's out there. I think he had a system for acquiring it and synthesizing it and making it easy to understand. And that's all he did. Anyway.
I mean, look, it's complicated. There's some value in that. I remember that guy, though. You couldn't not watch the infomercial because he was so colorful. Yeah.
That's what you need, man. You need a jacket with some cash symbols on. No, that's actually a good segue into what are I know for my office, our office shut down. So everybody is working from their particular homes. So we all hear from like, well, you can write off like, whatever amount of office space you use your house or your tax or whatever. I don't know if that's true, but what are some things that you're seeing now that you're implementing possibly for some of your clients in terms of tax write-offs for COVID related? I know we talk about, I'm talking about like things that might not be COVID related, but just happen to be more, in tune with what's going on today.
Yeah. So I guess the most common that you brought up is the home office deduction. Everyone's stuck at home and they're probably incurring some expenses related to that. So they're wondering if they can deduct it. So the first thing is if you're an employee, unfortunately you can't. You used to be able to, and tax reform a few years ago got rid of that. But if you're a business owner, you definitely can. There are a few restrictions you would want to be aware of. The home office deduction is definitely something that the IRS probably audits at a higher rate than normal because many people are aggressive with it. But basically, you have to have a dedicated space. So, and it doesn't have to be like its own room, but there needs to be an area that's just for work. That is your office space. Obviously, it's easiest if you have like a room. But yeah, I've seen people, use like their dining room, their formal dining room, and convert it and stop eating in there. I do think, like, if I was defending that person in an audit, I would have a hard time convincing the auditor, but you would really, you would need to say this is a dedicated space where you're conducting business exclusively for your business. Like, nothing else is going on there. So once that happens, you can compare the size of that room or that space to the total size of the house. And so let's say it's a 200 square foot bedroom and a 2,000 square foot house. So that's 10% of the total space. Every expense related to the home, you now can deduct 10% of that against your business income. So expenses you would have been paying anyways now are deductible. So it's kind of nice. There's also a simplified option where they will give you $5. The Internal Revenue Service will allow $5 per square foot. So if you don't want to go through the hassle of adding up your insurance, your taxes, your mortgage interest, what you pay your yard person, and et cetera. I would say it's worth it because probably it's higher than $5 a square foot if you got a nice house. But so in this example, at $5 a square foot and 200 square feet, you'd be deducting $1,000. So it's not,
that's pretty,
it's not huge numbers, but it's a little extra
to
help. Beyond that, I would just think about any personal items that you're using that are now business, right? So like if you had a business phone system at your office and now you're using your cell phone, well, you should be deducting that cell phone, right? And, anything like that. Yeah, that's kind of it,
So now what about we're about to have a whole bunch of businesses, I would assume, are going to have to file their returns. Okay. They're not going to have a lot of money to pay whatever taxes are owed. Is there any way to extend the time if you're a business owner, you have to file taxes?
Yeah, good question. So, normally, I'll just stick with individuals. I'm assuming most people have like a flow through business, so it's all going on their personal return.
Correct.
So April 15th is the deadline. You could file an extension to October 15th because of, the pandemic. The Internal Revenue Service moved the deadline for 2020 to July 15th, right? And the extended deadline of October 15th stayed the same. You have to file an extension. It's like a one-page document to do that. Since we're recording this in September, so if it hasn't been done, I would just get that return done as soon as possible.
Right.
But business returns are either due March 15th or April 15th, and then either September 15th or 10/15 with the extension. One thing I see a lot are people can't pay. I mean, I represent a lot of these people where they decided I was better off not filing a tax return because I couldn't pay. Definitely don't do that. If I could change someone's decision there today, it would warm my heart. And here's why. There are penalties. They're late filing and late payment penalties. The late filing penalty is completely preventable by just filing on time. And many people can't pay the IRS. If you can't pay the IRS, it's not like they're going to come put you in prison. There are many ways to work it out that I'll talk about, but just having a financial issue and being unable to pay them, file on time, avoid the late filing penalty, which is 5% per month, and it caps out at 25%. So after 5 months of being late, you owe 25% of the unpaid tax liability. So it can be a really large number that you could save. Late payment penalty starts accruing this year, July 15th, but every normal year was April 15th, and it's 0.5 percentage point per month, and it also caps out at 25%. So it can take like 4 years to fully cap out. The Internal Revenue Service is actually pretty friendly with payment plans. They, You can settle tax debts. You can get penalties waived. There's a lot of things you can do with them that we do. And, it's the government, it's the federal government. They have a lot of power. They can do, they can take property. They can do a lot of nasty things to you. But as long as you're proactive with it or you hire a professional, very easy to avoid all of that and to resolve the tax debt. I think it's pretty rare where we have a situation where we can't solve it and figure something out. For most people, if you owe less than $100,000, the Internal Revenue Service will give you an installment agreement with a pretty long term, like 7-8 years, potentially 9 years. And if it's your first time ever having a tax liability, they will likely waive your penalties too. So they're pretty friendly if you're a first timer. And even if you're not, they'll still work it out. Worst case scenario is always a long-term payment plan.
Oh, Jason, again, for the listener, is not necessarily, Jason's not the person that files your taxes for you. That's going to be your CPA or
Correct.
your grandmother that's really good at taxes, or the person that stands out on the street with the Statue of Liberty outfit saying
the waving sign.
Jason is the person that when you owe $150,000 in taxes and you have in your bank account the amount of coins that are in your couch, Jason is the one that goes in and argues to the government why you should not owe that $150,000. Can you quickly just walk us through that process of, if I know that I'm about to owe a whole bunch of money, I don't have that money, and you said, go ahead and file, don't be late on that. What are some things that could set me ahead other than filing on time before I come knock on Jason's door?
Well, I think the answer is knock on my door unless it's, under $10,000. At that point, it doesn't really make sense economically to hire me. But, what I see with most people is they wait to hire me until they've saved up money, I think, because they assume we're going to be expensive. Or, whatever, they have stuff going on in their life, they want to resolve it, but they wait until things are better. When you try to settle a tax debt with the IRS, I call it opposite land. The worse off you are, the more likely they are to settle. So, the less assets you have, the better. The less money you are making, the better. So you sort of want to act when things are not going well. Back in March and April and May, we were spending a lot of time checking in with current and former clients whose accounts were maybe almost resolved or we'd already resolved, to see if we could renegotiate based on a change in financial circumstances, because many of them, their incomes had dropped substantially. And I knew for some of them they would bounce back. So let's take advantage of this dip while it's here. It's not going to last forever. I had an operator of a very successful restaurant franchise where he was shut down for 2 or 3 weeks and they reopened. And they've been very successful at moving to drive-through and to go. And he's making more money now than he was pre-pandemic. But during that 1 month period, we were able to use the fact that his income had gone down a lot to get him a very favorable deal. But what I would say is when you owe them money, they start sending you notices, and they're scary. They're designed to be scary because they're trying to collect money from you. They want you to pay it, right? So the first thing I would say is, if you haven't been in that situation before, the world will not end. Don't get emotional about it. There will probably be 6 or 7 notices before it gets real. Now, I know you're not going to know when it gets real because you're not an expert in dealing with the IRS, but once you get that first notice, you do have some time to resolve it yourself or contact someone like me. If you do try to resolve it yourself, you're probably going to end up in a payment plan where you pay in full. The benefit of hiring someone like me is I can tell you if you qualify for anything else, and no one at the IRS is going to tell you that. They might suggest try this program or that program, but they don't really represent you and your interests. Their paycheck is from the IRS, and they're the people that are trying to get the money from you. So to answer your specific question, once you know you're going to owe money, whether you even owe it yet, it's probably good to contact someone like me.
That makes a lot of sense. So Jason, in the final minute or two, if someone is looking at that, if somebody did pop open their mail and they're hurting from the IRS, how does someone get in touch with you?
Yeah, so the best way is to call us at 404-233-9800. That's 404-233-9800. You can also look at us up on the internet. It's wiggamgear.com, wiggamgeer.com. We represent clients nationwide, and on many cases, we're able to do the work on a flat fee. We charge a fee to analyze the case to see what options the individual or business qualifies for, and then once we know what they qualify for, we can price a flat fee for the various resolution options that are available to them. And love helping people who have tax issues, and we're happy to chat with anyone.
Excellent. And I'll have all that information in the show notes if you're interested in getting in contact with Jason. Jason, a lot of great information today. Thank you so much for being on the show.
Rob, thanks for having me. Have a good one.
All right. I would not hesitate to contact Jason if you believe that you are going to be having a high tax burden that you're going to be unable to pay without some sort of deal, installment, or help. Reach out to his office. He's great. And again, I know from personal experience because I have used his offices before on my own. So hopefully you enjoyed this episode. Hopefully you found the content relevant and useful. If you have any suggestions for content, please reach out to us. You can hit me up on Instagram at Wedding Lawyer. I think that's what it is. Or you can hit me up on YouTube, Wedding Industry Law. And with that, we'll see you next time.
Thank you for listening to the Wedding Industry Law Podcast. This podcast is intended for general information only. Nothing in this podcast is intended to be legal advice. Do not rely on this podcast for your legal matter. Instead, consult an attorney in your area. Thanks, obrigada, até semana que vem.